So within the Bank of England, and if you hear some music in the background, it's my children dancing to YMCA. So the parts of the Bank of England that are involved in financial market intervention, the stuff you already know, Monetary Policy Committee, changing interest rates, quantitative easing. However, there's an additional part that the Bank of England does since Mark Carney became the governor, and that was what's called forward guidance. So it's a what if analysis of if the economy does this, then we will change interest rates. If the economy does that, we may look at quantitative easing. It's to give a little bit more forecasting to businesses to provide some information to help with decision making. So it's not an exact science, but it was something that Mark Carney brought in to provide a bit more information about what could happen in the future to try and stabilise financial markets. And the Monetary Policy Committee obviously is in charge of monetary policy, and the action they take or changes to interest rates or quantitative easing. The Financial Policy Committee, so that was Alex Brazier that we mentioned yesterday. One key thing they look at is financial stability and research around the financial sector in the UK. One of the key things they do in terms of policy is stress testing of banks. And I'll come back to what stress testing is. It's a form of information provision, and it's also kind of a lighter touch type of intervention to try to give banks the opportunity to take actions that will increase stability. The last part of the Bank of England is the part that links to action in terms of regulation, and that's the Prudential Regulation Authority. This is sometimes referred to as macro-prudential policy, which is keeping things stable, keeping things in the financial sector on a level which allows businesses and consumers to gain that trust and stability. And their main role is the regulation of the financial sector. So I mentioned yesterday about 1,500 financial institutions in the UK come under their authority, banks, insurers, credit unions, and so on. So some examples of the regulation that could take place. One last thing to be aware of is outside of the Bank of England's control, and to an extent outside of the government's control, but it is influenced by the government, and it is a non-governmental organisation, is the Financial Conduct Authority, and they have the authority to look at businesses within the financial system and make a judgment on whether they are acting in competitive or uncompetitive ways, and if they are creating market failures, they have the ability to fine. They also work closely with the Competition and Markets Authority to look at where there may be market dominance or monopolistic behaviour. So just a few graphs to kind of remember or remind ourselves. One, in terms of if there is a monopoly provision, then there could be regulated prices. So there would be a potential for a regulated price at the allocative efficiency level, and that would allow the market to provide more of a financial service. So, for example, a savings rate, but it could also be a maximum or minimum interest rate, depending on whether you wanted more or less savings or more or less lending within an economy. So, for example, they could have a minimum interest rate to discourage risky lending. Another graph that could be applied to this would be a quota graph. So within financial market, there could be a case where you would want less of a financial asset, so kind of riskier mortgages. You may want to reduce that, and that would be linked to something like an income to asset price ratio. So I mentioned yesterday that you'd have to earn maybe 5 times, or you could borrow 5 times your annual income on a mortgage, and this would reduce the amount of people gaining riskier mortgages. you might also have a quota on the amount of a deposit you require. So you'd have to have at least a 25% deposit. During the financial crisis, there were 0 deposit mortgages being given. There were sometimes 120% mortgages given. So you could borrow 20% beyond what the value of the property was, to allow you to improve it, and also just the theory that the asset price was going to continue to rise. So you would get that 20% back at some point in the future. So specific quotas that could be put in place to prevent that. One of the key regulations that the Financial Policy Committee and the PRA instilled was a capital requirement. So this is just a rough graph of the capital level within a bank in 2008. So only 2% of the assets of the bank were liquid assets, so things like cash, short-term deposits that could quickly be converted into cash to pay back savers. And since the financial crisis, this has been increased to a safer level, so a minimum requirement for banks to hold this, and I'll come back to why that was significant. But in terms of the financial crisis, a significant run on the banks, and the reason why banks like Bradford and Bingley and Northern Rock failed was because they didn't have those liquid assets to be able to give their savers their money back when they required it. Linking it back to the forward guidance, so the things that the Bank of England provides. So this graph just assumes that there is a socio-optimum price and quantity of whatever financial assets or financial products that are available, and the forward guidance by the Bank of England